In this problem, we'll take a look at segment reporting. Now remember, companies will want to not just have income for an entire organization, but may need to know income for each product line or each store or any other segment of the business. Java Inc. produces coffee makers and espresso machines. During the past year, the company produced and sold 40,000 coffee makers and 20,000 espresso machines. Fixed costs for Java totaled $800,000, of which $400,000 can be avoided if coffee makers are not produced, and $250,000 of which can be avoided if espresso machines are not produced. Revenue and variable cost information follow. Now remember, fixed costs are either direct or indirect to each segment. This company had $800,000 of total fixed cost, and the $400,000 that can be avoided if coffee makers are not produced, and $250,000 which can be avoided if espresso machines are not produced. That's another way of saying that these costs are direct to these two segments. Variable production costs are $20 for coffee makers, $40 for espresso machines. The selling price is $50 for coffee makers and $90 for espresso machines. In addition, a 10% sales commission is paid for each product line. Calculate the segment margin for each product line. So we're going to prepare an income statement for coffee makers, one for espresso machines, and then one for the total company. Remember that we sold 40,000 coffee makers and 20,000 espresso machines. And so sales are computed 40,000 times 50 and 20,000 times 90. That will total out to be $3.8 million for the entire company, which is made up of $2 million from coffee makers and $1.8 million from espresso machines. Next, we'll subtract the variable costs, one of which is variable cost of goods sold, and we can compute that for coffee makers by taking 40,000 units sold times $20 per unit cost, and for espresso machines, 20,000 units sold times $40 of cost. That will give us variable cost of goods sold of $800,000 for each segment, or a total of $1.6 million. We can't forget about the other selling expenses that are variable. They are 10% of sales. So for coffee makers, that's 10% of $2 million. For espresso machines, that's 10% of $1,800,000. Total variable selling expense is $380,000. So our contribution margin is $1,820,000 for the entire company, $1 million for coffee makers, and $820,000 for espresso machines. When you're computing segment margin, you next subtract the direct fixed costs. Those were given to be $400,000 for coffee makers and $250,000 for espresso machines, totaling $650,000 for the entire company. This will give a segment margin of $1,170,000 in total, $600,000 for coffee makers and $570,000 for espresso machines. Now that's what the problem asked us to do, but of course the company may go ahead and compute the net operating income. So let's go ahead and do that. Our common fixed costs are $150,000. I know that because our total fixed costs are $800,000, our direct fixed costs are $650,000, so our common fixed costs are $150,000, because remember, fixed costs are either direct or indirect. Another name for indirect is common fixed costs. Net operating income for the entire company is $1,020,000. Now, if we wanted to compute that for coffee makers or espresso machines, we would need to know how the company allocates common fixed costs. We don't have that information, so we'll leave it at this, $1,020,000 $20,000 for the entire company. Get some practice with this concept and bring questions if you have them.